Hi and welcome to another edition of Top Tips Tuesday, brought to you by Jeff from GCD Property. So this week we're looking at tips for evaluating the risks and rewards of different types of property investment strategies. So number one strategy could be flipping. So this is generally where you're buying a property, generally you'd be doing some renovation and you're turning that property over in a fairly quick time frame. There is certainly some risks involved. You've got to be very aware of what part of the property market you're in. Is it at the top of the market declining, or is it on increasing? You've got to be very aware and on point with your budget, so how much you're spending on the project. You've got to factor in all the purchase, holding and selling costs. So your numbers have to be really sharp if you're looking to flip, and I'd recommend that you have some experience and working out how much, getting quotes if you're going to renovate or spend money on the property. Have a budget, and it has to be pretty sharp budget, and also have a time frame. It's very important. So the longer you take to purchase that property on sell that property, the less profit you're going to make. But the upside is it can be very profitable, and you can potentially make a lot of immediate equity or cash in a short space of time. So it's those people that are doing flipping can do it very well if you're on point, but you have to have some experience and really know what you're doing and having a really focus on that particular project and make sure it gets done on budget and on time. Number two strategy could be commercial property. So this is generally a longer term buy and hold. The pros of having commercial property is once you've got a tenant in place, generally the tenants will pay all the outgoings, so rates, insurances, other costs associated with the property. So the actual income, the net income on a commercial property can be higher than residential. The risks are that you have to find the right tenant because it is a commercial property. It's not going to suit every business type. So generally commercial investors do very well if they're experienced and done projects, but you do have to forecast there may be some time, a larger time frame between tenants, unlike residential property. So just be aware of that. But again, the upside could be longer term net or stronger net income. The third strategy is the more traditional buy and hold. So this is where you're buying the investment property. Generally, you'd put tenants in place and hold that property for the long term. Personally, I would consider that the safest strategy because property markets can change, but we look at property investment over the long term. Standard houses and standard residential areas perform very well over the longer term. So generally putting a tenant in place, holding that property to either sell down your portfolio or recycle that equity to buy your next property. So the benefit of that is you're having a rental income coming in. It's quite secure as long as you're buying an area where there's high rental demand, and that capital growth will appear over the long term. The downside with buy and hold is you can't immediately turn that equity into cash, and that means you've got to hold the property for the longer term. So I hope that's really helped. It's really important to look at those three strategies and work out which one suits yourself. If you ever want a discussion on that and go through those options, you're welcome to reach out. Thanks for watching, and see you next Tuesday.